Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Tuesday, August 20th, 2019. If you remember the site, this will the market cap or the general stock market analysis will largely just be a recap of the video I got out to you this afternoon. So that one's a little more detailed, and we also covered treasury bonds, gold, and some important developments I think that really tie in together with the stock market. As well as semiconductors were covered. But let me just do a brief overview again for those that might have missed that, or of course those coming in the right side of the chart viewing the public content. All right, so this is SPY, and to keep it simple, and again I said this earlier in that other video, at the risk of maybe oversimplifying things here, this is the level I'm watching. We've been one thing I can tell you definitively is that is a important technical level, and what I'm referring to is the sideways trading range between 294 and roughly 282 on SPY. There it is. That goes all the way back to August 3rd, Friday, August 3rd. We gapped down into there. That was the false. That was the trigger for the failed breakout. What I'm referring to, the S&P 500. That's what we're looking at here on SPY. We had a failure right here, a failure at that same exact level again, another failure after a brief one-day attempt to get out, and then finally we broke out. And as I stated at the time, both in advance and after it happened, my expectation was that breakout would fail and prove to be what it has been, what we call a bull trap, aka false breakout, fake out, whatever you want to call it. Why? Because it had everything, all things I had talked about, the negative divergence. I gave you a couple weeks back, I went over my low volume indicator on the markets. I have a low volume, a certain level when volume hits that corrections have been triggered at. That played right into this as well. And then of course we had the wedge, and that's where the sell signal came. And then, so if you missed it the day of the Fed, we had a secondary back test, and then again that was still above support at that point, and it was then on August 3rd, I think it was, Friday, that we failed. So again, to me, this is an important level. We've been in a sideways trading range. It's a fairly large trading range, and what I had said earlier is trading ranges such as this, technical analysis, it works like a coiled spring. This is a coiled spring building energy. We're bouncing to the top, the bottom, and typically the longer the range or the bigger the range, the more powerful the move out. So you have really obviously two solutions for this trading range: an upside break, which would be bullish, and what I said earlier is I put an asterisk in there is for the bullish, my bullish scenario. I still favor and maintain the downside scenario. As I said recently, I'm not so crazy about how long we've traded around. My expectation a couple weeks ago, and I felt pretty sort of strong with those convictions, is that we'd go down here. We got that was telegraphed and expected, and then when we got here I said we'll probably bounce anywhere from this point all the way up to 294. It's exactly what we did, but we did it again and again and again all day. Well, yesterday we fell a little shy in SPY. I'll get to QQQ in a second. So my expectation was a typical, at least an ABC with a break to come shortly after the initial, or at least a second test of that top of that level. Each time we hit it, I stated, and what I'll say again, I think it's an objective shorting entry every time you get there, because as I like to say, resistance is resistance until unless taken out. So 294 or the comparable level on SPY, I'll get to in a second, remains resistance. So, but what happened, of course, is, like I said, we've kind of chopped around. For now, it's been a little over 2 weeks, just over 2 weeks. We've moved around in that range. This is an ABC like we had here. This was a correction. This was the largest correction of the year up until, well, this was the largest so far. This was the sharpest leg down. In just 4 days we dropped about 7% or so. And this is also, here's that initial thrust down from the in early October 2018, and then there's a kick up. There's your ABC, or at least your initial leg down. Yeah, you get near-term oversold, especially after coming off a bull trend. You have the dip buyers. It's almost a certainty you're going to get your first wave of dip buyers, and then you kicked up again. And so what happened here, and the analogy I used earlier today, and I'll use it again here, is again, this is a pattern, building energy right now that we're going to break one way to the other. I still have my preferred scenario. My convictions are a little less strong than they were back here because the fact that we've traded around so long. I thought the demand dynamics were clearly, skewed to the downside, and they haven't been so far. Now, of course, there's been just massive government intervention. Not only the rate cut, the rate cut came here, but more talks of that. The president is, crying like a baby to get Powell to come in and cut more, cut two more. And coming out now in all kinds of gimmicks. I've seen something else that, some kind of new payroll tax cuts, the latest. And it's a full court press right now to prevent what I believe, and I think and other people do, an inevitable recession. It's priced into the charts, a bear market that's priced into the charts, I should say. The recession is a natural part of the business cycle. I could sit here and talk for I could talk for an hour about that. You have to have recessions. It clears out the excesses in the economy. We always have and we always will. So it's just a matter of how far can kick it down, and that's what's going on here. And I'll say retail sales, things like that come in, but there's the three pillars I talked about in recent videos over the last few months. Three pillars that I'm watching, and they're all interrelated. One would be the stock market, which we're covering today. The other is the consumer. Consumer spending makes up about 70% of GDP, so over 2/3 or more is based on consumer spending, and then the housing market, and they're all going to go together. Once this one buckles, or any of these three pillars. If the stock market buckles first, then consumers' confidence and then spending will plummet. Housing market will go down with it. If consumer spending starts to roll over first, the stock market will then follow because of the importance again, and or the housing market, because again, as I did in that video, that's the wealth effect. That's where the majority of people in the stock market have a good percentage of their wealth is in their home. And so right now, those three pillars have held up, and when one goes, they all eventually go together. That's just how it works. So we're watching that. And again, so that's what's kept this market up. The consumer has been surprisingly resilient so far. So maybe this does happen. So watch for a breakout and just prepare for it. As I said in the video earlier today to members, if you're bullish, then have your plan. Get ready to go. You want to take a breakout, what to look for. I'm going to drill down to the 60-minute charts in a second and tell you why I don't think that we'll go much higher than just a brief pop. We have a little stop rate, a pop above there, and that's why again I have my bullish scenario only calls for about a 1% pop if we happen to pop the top of the levels, which is almost nothing. So I'll sit tight, on my swing short positions for the time being, if that happens. But of course, if we go up much more than that, then you run at the highs, and of course that would certainly change a lot here in the technical, or start to change some things. Not so much the monthly and weekly charts right away, but it certainly sort of foil this, the nice bearish setup we've had here on the daily charts. All right, so that's SPY, QQQ. Same story. Let's do this. Let's go to this board here, and there it is. So then the range is about, rounding these numbers off, about 189 down to about 179. Now QQQ has actually made higher lows at the bottom of the range, where SPY had equal lows, but still QQQ is going to have to undercut that recent low to open the door for what I believe will be the next impulsive wave of selling. This is impulsive selling. This is impulsive selling. Most selling usually is that way. Sometimes you can stair step down a little, but that's what I'm looking for there. And again, of course, as I said, so bulls want to see 189 get taken out, and with conviction, and the more we can get away from that level, the better it is for the technical posture in the bullish case of the market. That you might, if you think there's another 10+% upside in the stock market this year, that's what you want to see, and of course a break of the other highs. Bears, those shorting or looking to get short, obviously want to see it first, a move back down to the bottom of the channel. Possible we can bounce if we get there again, but sooner or later we're going to break out. And these price channels don't last forever, and then of course a break down below, ideally impulsive. So that's that. And so on SPY, if I didn't cover this earlier, like I said, second iteration of this video today, there's our recent trading range. Remember back in 2018 at the highs, we had the initial leg down, we had a kickback rally then, and we started to set up also a big trading range, which you can see back then, 1, 2, 3, several visits, we'd have to you'd pretty much expand this. If I zoom in, you see it kind of looks like it there, right? Same thing, but on a little smaller scale now. But the same net effect. It's a coiled spring, energy building between this range. You came 1, 2, 3 tests of those highs. 1, 2, 3 tests successful at the bottom. Finally, when you broke it, that was it. That's all she wrote. It didn't look back. The SPY dropped another, I think that's 11, 12%, QQQ even more from right there, and that was impulsive selling. That's, again, what I've been looking for and expecting here. Just because it didn't happen on this first kickback rally doesn't mean that it's not going to happen. It just needs to happen before we have our next high probability good sell signal to get in and short and hold on to some shorts, of course with those stops in place, as always, in case proves to be a little whipsaw signal. And then what I said earlier today, a couple of posts I made on the front page and as well in the other video, these are the 60-minute charts. Remember, SPY, since it hit here October 5th, those lows, I've had these bounce targets, 294 on SPY. We've come up several times. We fell a little shy on this bounce here. This one's all been about tech. Everybody's buying what they love. Apple, Amazon, Facebook, all those big names. And on QQQ, you can see we did hit. I had the same bounce target, going back, from the lows, 188.37, hit it once, hit it twice with a little Momo overshoot, hit it all day yesterday, and that's the thing. I highlighted this. We have a very, very tight trading range. Volatility is going down. Price compression, that was yesterday's trading range right there, and then today, look at all those failures. I mean, you can say what you want about technical analysis. It doesn't always work, and when it doesn't work, I usually say it's a failure on my part to recognize, properly read the tea leaves, if you will. But in this case, one would have a hard time arguing that 188 to 189 level, we'll call it, because there's some, one would have a hard time saying that that is not a technically significant level. So, and then that whole false breakout or stop rate scenario I laid out earlier is, okay, so if you recognize that, you say, okay, Randy, you got a good point. There's something going on here between 189. Buyers can't take it out there. Sellers, keep stepping in every time we get there, but yet we keep pushing against it. So if it breaks, probably, I think it's logical to assume there's a ton of stop loss orders on shorts right here. And so if they can pop it, they'll pop those stop loss orders, which then, when you have a short trade, a stop loss order is a buy to cover your short position. So that buying begets more buying, and it's a vicious cycle. Bulls would jump in. I mean, if I was bullish and thought the market was going to new highs, I'd be jumping in with both fists on a breakout above 189. And you'll probably, if that happens, you get somewhere close to there, you'll probably see those stop pops, stop raid, stops get hit. But then, what I was saying earlier is you have that mountain of overhead, a big overhead resistance level at least. So let's not call it a mountain, although if you view it this way, go back to that daily chart. Remember, that was the breakout in QQQ. Turn off these lines. In SPY and XLK, everything I covered yesterday, you had a previous reaction high right here. You had some highs here, and this was the breakout. So this is, a little mountain, if you will. Either way, the bottom of that level, once the breakout failed, that was support, and it's now resistance. So go back to the 60-minute chart, and this is what I'm getting at. So the market has its work to do. What I'm trying to say is just a pop above 189 is not clear sailing. It's not clear skies ahead. You have a downtrend lines on QQQ and SPY, and you have those very significant false breakouts, bull trap levels there, which is, somewhere in those, in that 190, we'll call it 190 to 190, 150 or so, somewhere in there. And it's, comparable levels on SPY. And again, I mentioned in yesterday's video, XLK as well. This is the tech sector. Tech is the market. Make no mistakes about it. You put a chart, if you don't believe me, just overlay a chart of XLK and QQQ. QQQ has vastly outperformed the S&P 500 on the way up because the NASDAQ 100 is very heavy in the tech stocks, the higher growth companies. You don't have dividend, utility stocks and financials bogging you down. You have the high growth tech stocks. So therefore, I can use XLK as a proxy. I could trade the market. I could fire off buy and sell orders on NQ all day long if you didn't even let me look at a chart on NQ or QQQ, just trading XLK, especially on long-term analysis. So what I see here is a very significant level. Previous high, failure. Tried again, broke out finally, and as expected, it was a fake out, false breakout, and this is the point it failed when we gap down back below that level. And so I mentioned it yesterday. We've been bouncing along there. XLK has been bouncing, bouncing, bouncing. So bulls want to see this. Maybe they get it. It's not my preferred scenario. Bears want to see the bottom of those ranges get taken out. And if they do, I expect it to be an impulsive wave of selling, not a little stair step down. I think we'll have a quick move down. Again, I don't want to give targets now. If I happen to make that an official trade, I'll do that on the site. Okay, and a quick update on the futures. I believe I covered these in the last update I did. If not, it would have been on the site as posted static chart images. We had a downtrend line in here on NQ. We've had it for a while, and you can see and this uptrend line. So these were the two things I was watching recently. So the other day I said you had, as QQQ and SPY and everything else have come up to resistance, you have NQ also at the top of the trading range. It offered an objective short here on the breakdown of the trend line yesterday. We didn't really have the impulsive selling. We broke down, kicked up, and then we tested that trend line all day. And we finally, towards the close today, even after the market closed, you won't see this in QQQ unless you pull a chart showing after hours. We continued to slide, a little nice slide after the close, the 4 p.m. close today. That is reflected here, by the way, on the futures. So that's to me, point being, this is a clear, very clean and clear uptrend line. Breakdown. In fact, it looks like this. We had, remember, an impulsive move up here following that breakout. There was a price channel. We broke out, had a sharp leg up. We kind of consolidated, rolled over, kind of broke below the trend, didn't go down right away, and then boom. That's sort of what's happening here. Kind of consolidated a little sideways. Bulls might have been seeing what they want to see, looking for a bull flag. I don't know, but it didn't really didn't make the cut for me. And then boom, we started to move lower. So if we continue lower overnight, we did gap down today as I was leaning towards, but it wasn't much of a gap on QQQ. It was a small gap, so it's just. But the important thing is we closed the day red, and you can see now the NQs are down 0.77%. And looking at this, I'd say there's probably more, but if I'm wrong, this is what you want to look for. If you want to go long NQ or cover shorts, well, you have a trend line here. I would, of course, all the charts I've covered, XLK, SPY, QQQ, NQ, and of course ES, take them all together. And if we pop there, like I said, I don't think NQ is going too far, at least not without a fight from the bears, because there's quite a bit of resistance just overhead, just as you have on QQQ, as I mentioned before. Finally, ES, for you S&P 500 traders, you had the same uptrend line. Pretty simple and clear stuff. I mean, uptrend lines don't get much more defined than this, here on a 60-minute chart. And we broke down, ES broke down, had a little kickback rally, floundered around most of today, and then finally started selling off, and it's coming up here on my first target. Next target's a little below there. And what I'd expect now, since we failed once again at the top of those trading ranges, I would expect we come back down to the channel, and I would think that if we get even anywhere close to the lows, the next time around we'll just undercut them and take them out. That's my guess, but again, respect whatever happens. If I'm wrong and we go up and we pop these and you're short and you try to ride that out, you're gonna feel a lot of pain. So those are the levels to watch. And again, which one would really concern me and tell me to start closing out some of those swing shorts? Right here, about that level. Those, remember, really where the breakouts failed on SPY and QQQ and XLK and everything else. My plan back here when I covered the shorts on the initial leg, went long, was to go long and then scale out from the bottom of the gaps up to those top of those levels. So this is where my average cost is right here, somewhere in the middle on the swing shorts. So another 1% or so upside above the top of that level. While I'm not going to continue to add, it's certainly plenty of room to give swing short positions. And then finally, one more chart and we'll wrap it up. Found this one from an article, I think it was Business Insider, and the chart is from RBC Capital Markets. And what they're showing is the net long positions for U.S. stock futures. So that's your NQ, ES, the big contracts on the S&P 500, things like that. So there it is, net long positions. And you can see it peaking at highs. And you might say, Randy, that's good. These are the professionals, asset managers. These aren't retail. This is not the dumb money. This is the smart money. So yeah, they're bullish, then it's got to be good. No, it's not good, because when everybody's bullish, when everyone's all in, the majority, I'm speaking generally here, but when the last bull has bought his or her last share of Apple, QQQ, SPY, there's nobody else left to buy. When the bulls, those bullish, are fully invested and all their money's committed, they have nothing left to do but sell at that point. And what happens too is you get an overcrowded trade. When everybody's on one side of the trade, you get these lopsided trades. So just to take a quick look at this, as they say here, back here, this was, by the way, this was January of 2018. If you weren't trading, look back. We had the record low period of volatility leading up to late January 2018. A steady eddy, not a runaway market, but just a relentless day after day after day climb, bull trend. It sort of ended with a little mini blow off top in January, and at that point, the net long positions in stock futures hit the highest level they had since right before the crash back here. This was the top of the last bull market, October 2007. That was followed by a 55+% drop in the stock market, and that was the last time that everybody had been so bullish, asset managers at least. And you can see here we had a shot across the bow back in 2006, I believe it was, early 07, late 06, just like here. So basically you can see January, this indicator, once you cross that line, it foreshadowed that almost immediately, that big drop in January. Remember, and then we got there again. September was the peak in the market before that, the biggest drop we had in the fourth quarter of 2018. Markets fell well over 20%. That was the biggest drop we've had since the bull market started. In fact, technically it was a bear market if you want to count it that way. We dropped over 20%. And again, that was foreshadowed by this chart. And so once again, we hit that level. So what does this mean to me? Well, it tells me that anything is possible, but most likely it's telling me that this relatively small drop of what did I say, about 6-7%, depends on what index you're looking at, yeah, about 7% in the S&P, is not nearly enough to satisfy that, because you had those bigger drops before. These are what I call the tremors, not the aftershocks, the ones that come before the earthquake. These were that's what that second one resulted in. And so far that's why I'm leaning to more downside. There's just too much bullishness, too much long positioning, and things that still I think need to be unwind. Now the thing about that is it's a vicious cycle, and it's kind of conditional on us going lower, because what causes those one-sided trades to lead to these big drops like this, as I talked about back here before it even happened, and then while it was about to happen, is everybody's on one side of the trade, and those institutions, especially professional money managers, they have to cut their losses. They don't buy and hope invest like retail traders. Buy and hope is this, joking word term for retail investors. Instead of buy and hold, they buy and hope. In other words, bull markets are going to bail you out. You just hold on, put your head under the pillow, bury it in the sand, and you're going to be bailed out in a bull market. That's what a bull market does. So no matter where you go, you're going to wish, I'll just get back to where I was, but no, everything's going good, so I'm going to hold tight. But pros can't do that. They have certain metrics, they have to cut their losses at some point. And like you and I, they also often trade on leverage, on margin, and they're going to get margin calls. So even if they wanted to, let's say, extend their stop losses, they see a big reversal coming. If you start to roll down, they get margin calls, forced selling. They get a call from their broker saying you've got till 4 p.m. to either put more money in this account or close some of your positions, or we're going to do it for you. That's what margin calls are, and that's where you get these waterfall sell-offs. It's panic selling, forced selling for margin calls, stops being hit on longs, all of it together. And so there it is, guys. It either happens or it doesn't. Like I said, it's conditional. As long as we don't break below there. So if you're long and and you think I'm preaching, dramatic stuff, I try not to, be dramatic in my analysis. I'm just telling you something that could happen if we take out those lows, and that is my expectation, to see quick impulsive selling again, if that happens. But it's conditional, because if it doesn't happen, guess what? Nobody stops are hit. The longs don't have their stops hit, and they don't get margin calls. Count value goes up, they have more equity. They're less likely to get a margin call. So there it is, and there's the levels to watch. So we'll go from here, and if we pop to the upside of the range and we go much above there, then I'll start to my analysis, my outlook might change. But like I said, the red flags, and I did an extensive video on breadth indicators yesterday. That all of them pretty much tell me the same thing. So we pop to the new highs. I'll go back to what I was doing back here and back here. Focus on individual stocks, sectors, commodities, gold, treasury bonds, other things like that, long and short, and just close out swing shorts. But I wouldn't re-enter. I have no desire, at least anytime soon, unless things really change, to flip from a net at least on the broad markets. That's just, again, one piece of my portfolio. I trade very diversified, different pieces of pie: bonds, gold, commodities, individual stocks, and but as far as the equity market, most points in time I'm either net long or net short, and to varying degrees as well. So that will, I just want to say, this isn't a magic button or level for me where all of a sudden I go from being net short under that level to reversing and going to net long. That's not how that works for me. However, here I might add to my sizable short positions if that gets taken out, based on, because I see a much better likelihood of this happening than this. Hopefully that makes sense for you guys. All right, let's wrap it up here. We'll see where things go tomorrow, and we'll just go from there. Take it one day at a time. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.